It's not every day that we see a stock from $20 to $500 in just 11 days. Truth be told, I haven't seen anything like that in the stock market before. So you might be asking, how was this possible? Well, there are 5 factors to understand. And in this video, we'll discuss what those factors are. What's happening, traders? If you're new here, please subscribe and hit that notification bell so you don't miss out on anything as I post weekly trading videos. I'll try to explain this as easy as I can, so please pause the video if you have to or write your questions down in the comment section below and I'll answer them. Prices move based on supply and demand. The demand is higher, price goes up. Supply is higher, then the price goes down. Now, there are 5 factors to understand why GameStop moved as it did past couple of days and how it gathered demand. Note that this demand are both natural and forced demand. Number 1, fundamental change. GameStop sales increased in November 2020 compared to the year prior. And the next fundamental change was that Ryan Cohen, the co-founder of Chewy, will be on the board of directors for GameStop. Number 2, enter Wallstreetbets. Wallstreetbets is a subreddit where members are discussing stocks and options trading. These participants have the reputation to be highly speculative and has that YOLO trading mentality that is placing their money all in one stock or couple of stocks. This time, they had their eyes on GameStop. The first 2 factors are the natural demand. The next 3 that I'll be discussing are what I call forced demands. So number 3, high short percentage. To those who don't know, I'll be explaining shorting briefly. So what we know is a typical buy and sell. We buy low, we sell higher, we get a profit. That's what we call as a long. And the opposite of it, which is short, we sell a stock higher and profit when we buy it lower. But what product can we sell if we don't own anything? That's where we borrow something. And the more we borrow a stock, the higher its short percentage will be. So if we have 100,000 shares of a stock, the maximum theoretically that we can borrow will be 100,000 of those shares. What happened in GameStop was that the short percentage was higher than 100%. And remember, when shorting, we sell it here with the hopes that we can buy it down here and return what we borrowed. What happens when the stock does not go down? So it goes up and we're forced to take the loss and we buy the stock to exit our position, which means if we buy enough amount to move the market, then the price of the stock will continue to go higher. Number 4, option trading. Again, please bear with me for those who don't know about options, but I've prepared some animations to help you understand what option trading is. To help explain, we have 3 entities. We have the HTI traders, big player A, and the market. For example, there's a stock trading at $9 and I am expecting it to go higher in few days time. So I buy a call option priced at $10, which gives me the right to own 100 shares of that stock if I use it, regardless of what the market price of that stock is during the time that I use it. If at expiration the stock did not move above $10, then I won't use this contract or this call option because I can rather buy 100 shares of that same stock at the open market for a lower price, say $9. Now, in essence, this will only benefit me if the price of the stock goes above 10. I'll use my call option contract and big player A will be forced to give me 100 shares of that stock regardless of what price he has to buy them for. After buying 100 shares of this stock from big player A, I can then go out to the open market and sell it for, let's say, $20. So I gained $10 in each share. Now imagine how big I profited from that single call option. Enter Wallstreetbets, where they were buying a lot of these call options. And if someone was profiting big from this move, it means there's also someone losing big on these moves. remember that I paid big player A a certain amount of money to buy that one call option. For big player A to get all those money without returning anything back, the stock needs to go down below $10 before expiration date, which leads us to factor number 5, shorting more. To bring the price down below 10, as I've explained earlier, the supply should be higher compared to the demand. Now, how can they provide a higher supply if the demand is already picking up? They inject an artificial supply. How? By short selling. So when they short sell, they sell a stock, and what happens is if there is enough money being placed which moves the stock down and it expires below 10, then all the money provided to big player A will be all his. The catch here is what happens if the stock doesn't go down. This is what I call a forced demand. Now, there are 3 factors which will drive the price higher. The high short percentage, which they need to buy stocks just to exit their position. We have the option trading, which again, they have to buy stocks just to exit their position. And the last one, where they try to pin down the price below 10. They also need to buy shares just to exit their position. Now, we have a loop where each one is triggered by the other. And I didn't even mention yet breakout traders and momentum traders. Big names like Chamath buying more call options and Elon Musk tweeting about it doesn't really help the short sellers at this point. Adding all of these factors together, we, my dear viewers, get Gamestop. There will most likely be policies being placed after it's all said and done. But as of now, let's just be safe out there and learn critical lessons from this type of moves and determine how we can profit from it in the future. Hopefully you understood something today, and if this video provides value to you, please help me grow this channel by hitting the like button, subscribing if you haven't done so, share this to your friends, families, and if you have some questions, please leave them down in the comment section below so I can answer them. Before we go, I just want to tell you that you will get 4 free stocks if you use the link down in the description below, sign up to Webull, and deposit $100. You can also follow me on Twitter, as I post there daily if you want to know what trades I'm entering and what trades I am exiting. With that being said, respect risk and continue to hustle, trade, and invest.